This is Radio Entrepreneurs. My name is Jeffrey Davis, and welcome back. All week long, we've been featuring the show from the Scoreboard Bar and Grill from the Crown Plaza Hotel in Woburn, Mass. Thanks to our friends and sponsors at Centerpoint Advisors. And speaking of Centerpoint Advisors, we have our financial reporter sitting on the desk, Rich Greene. Hi, Richard.
Hi, Jeff. How are you?
Good, thanks.
Thanks for having me.
Good. Richard, you've stirred up a whole week's worth of activity up here at the hotel.
Yeah, it's been a great week. We're fortunate to have relationships with a lot of entrepreneurs. People like to tell their stories about their businesses and going back and going forward. So I find you learn a lot from listening to these people's stories.
How's the financial investment business doing? What are the trends out on the market right now?
Well, what's interesting, Jeff, I was thinking before we had our conversation that it's almost hard to believe we're in Q4. It's the fourth quarter of 2014 already.
Don't depress me.
And although a lot of investment returns tend to be looked at on an annual return, prior 1 year, 3 year, 5 year, 10 year, et cetera, quarterly returns are, so the people in the business sort of mark their business progress and results on a quarterly basis. And it's remarkable that here we are. We're already at the time of the year where what's one of the topics of conversation? Tax planning, right?
Right.
We start reviewing the account. This is the month. We start reviewing portfolios. Do we have capital gains? Do we have capital losses?
Right.
Have we taken gains? We do research for people own mutual funds. And sometimes the mutual funds won't tell you in advance, proactively, oh, you have a large capital gain coming because our portfolio manager sold out some successful stocks back in Q1, Q2. So that has to be put into the mix.
Right.
So it's that's where a lot of good planning. We definitely encourage our clients to meet with their tax people sooner versus later, typically by the end of October, early November, gives them time to plan.
And a lot of people, a lot of consumers are worried that there's going to be an adjustment coming on the horizon. That we're
statistically, the euphemism for
statistically we're due.
Yes. Well, it's interesting. The most recent quarter had a little bit more positive progress for the broader averages, but one of the areas that had fueled a lot of growth and very good returns over the last several years is smaller companies and mid-sized companies, and there was a lot of profit taking there. So it was a very significant divergence between how the big blue chips or flight to quality stocks performed relative to the smaller companies. You have to be careful about the income investor has to be very mindful of their allocation to stocks, which can fluctuate in value, as we just said, by a material amount of money. Even though a lot of retired investors like dividend stocks, the Exxons and the Verizons of the world, and typically, unless things are severe, what happened in 2008 with banks and their dividends, a lot of industrial companies, they won't cut their dividend or eliminate. So they will still get a cash flow, but nobody likes opening up their statement and seeing their portfolio is worth 15% less than it was at the beginning of the year or the
scary.
End of last year.
15% is bad.
Yes, and it's from where we've come from. We'll eventually something will may break. It is futile though to build a business or a planning portfolio around what's the next big concern.